For 2 decades, China built its growth on concrete. Real estate became nearly 25–30% of China's GDP when you include construction, materials, and related industries. Apartments were not just homes, they were investments. Families stored wealth in property. Developers borrowed heavily. Land sales funded local governments. Construction never stopped, until it did. In 2020, China introduced the 3 red lines policy to restrict developer borrowing. Debt-fueled growth suddenly hit a wall. Major developers like Evergrande defaulted. Housing sales fell sharply. Prices declined across multiple cities. Construction slowed dramatically. And when property slows in China, everything slows. Steel demand falls, cement production drops. Local government revenues shrink because land sales collapse. Youth unemployment surged above 20% at one point. Consumer confidence weakened. Households stopped spending. Because when your primary asset falls in value, you don't feel rich anymore. This is called the wealth effect. China's property market was once the engine of growth. Now it's the drag. The bigger risk isn't a sudden crash like 2008 in the United States. It's something slower, a prolonged stagnation. And because China is the world's second-largest economy, a slowdown doesn't stay domestic. It affects commodity exporters. It affects global trade. It affects supply chains. When China slows, the world feels it. At the micro level, falling housing prices reduce household net wealth. In China, property represents a major share of household assets. When property values decline, perceived wealth declines. According to the wealth effect theory, lower asset values reduce consumer spending. Graphically, a decline in housing prices shifts the household consumption function downward. Demand for discretionary goods falls. Retail sales weaken. This creates a negative feedback loop. Lower spending reduces firm revenues. Firms reduce hiring. Income uncertainty increases. Micro lesson: asset price declines can reduce demand even without income falling immediately. Expectations and confidence matter. At the macro level, the property sector's large share of GDP creates multiplier effects. Real estate influences construction, steel, cement, banking, and local government finance. When housing construction slows, demand for raw materials declines. This affects global commodity exporters like Australia and Brazil. Local governments in China depend heavily on land sales for revenue. When developers stop buying land, fiscal pressure increases. Lower property investment reduces aggregate demand. GDP growth slows. Unlike a banking panic, this is a structural slowdown driven by debt overhang and demographic shifts. Macro lesson: when a growth model relies heavily on one sector, its slowdown can create prolonged stagnation rather than sharp collapse. Subscribe to Econ Matrix, where economics meets reality.